Welcome to our financial topic presentation on the student loan crisis, where we will go over the history, the trends and issues, political climate, and the future directions of student loans. This presentation is by Jamie McDowell, Maizie Jones, Ben Szot, and JT Story. The history of student loans began in the late 11th century when student loans were introduced into higher education institutions in medieval Europe. This was primarily to support young men in their journeys of having a future role in the Catholic Church as well as future government positions. In 1240, Robert Grotest, the Bishop of Lincoln, used Oxford University money to launch the first documented student loan system. He named it the St. Fridswide's Chest. This was literally a chest, bound by two different locks, with each key held by a different college faculty member. To receive said loan, the student had to have something of value to deposit into the chest as collateral. Students used silver spoons, gold plates, and the most collateralized items were textbooks. In the late Middle Ages, this included Aristotle, the Bible, law codes, and medical tracts. Medieval universities excluded many groups like religious minorities and especially women. By the 14th century, roughly 20 more loan chests had appeared, and they held the equivalent of millions of today's dollars. The money came from wealthy families who either wanted to support scholars or liked the thought of their name being associated with a chest. Borrowing money went from focusing on low-income students to providing loans to all types of students, many with parental support and some wealth. In 1544, Robert Rounce and John Stanshaw, armed with an iron bar and a hammer, broke into the congregation house, smashed all of the loan chests, and took most of the chest wealth. When the printing press was created, simpler manuscript production made books cheaper to produce and less desirable as collateral. Bankers began to give loans based on the predicted future returns, rather than collateral of property and possessions. In 1624, England legalized the interest-bearing loans, and throughout the 17th century, students became just like other borrowers and could end up in debtors' prisons, which began to increase with inmates drastically. By the mid-1800s, student loans arrived in the United States, specifically through Harvard. In 1965, the Department of Education created federally guaranteed student loans by private lenders and were made available to students across the country. Students could collateralize their future incomes without knowing what those incomes would be to complete their degree. Following this pattern, loans provided opportunities to many to pursue careers otherwise unavailable, and the age of the six-figure student loans arises, which could be viewed as a virtual debtor's prison. The student loan crisis was influenced by the idea of chasing the American dream. Until 2010, there was no risk of loss for banks since the United States government guaranteed student loans. With educational institutions' revenues increasing due to higher enrollments, as well as increased tuitions and fees, loans have been provided without ensuring the repayment of those funds by the student borrowers themselves. Without risk of loss, loans were approved at increasing rates. The federal student aid law, administered by the U.S. Department of Education, disperses more than $150 billion in federal student aid through grants, work-study programs, and loans for post-secondary education. In 2014, the amount of outstanding student loans was estimated by the Federal Reserve Bank of New York to be $902 billion. Out of this total, approximately $864 billion was provided by the federal government and approximately $150 billion by private lenders. Of the total $902 billion in student debt, approximately $85 billion is past due. Student debt has nearly doubled from $0.5 trillion in 2007 to over $1 trillion in 2013. And as of 2024 currently, $1.75 trillion in total student loan debt, including federal and private loans, has accrued, and nearly $29,000 is owed per borrower on average. These estimations have only increased over the years.
Now we're going to be taking a little bit of a closer look at the current political climate in the federal government surrounding student loans and the student debt crisis. So the federal government has taken actions and has created programs that do assist with relieving borrowers from the burden of their debts. For example, during the COVID pandemic, as a part of the federal government's wider relief efforts to assist Americans, they paused all repayments from March 2020 until October of 2023 and then set the interest rate at 0%. So this effectively paused student loans for 3.5 years. This did have some issues arise when these loan payments restarted because many students had not made any repayments on their loans so far, and so it was a little bit, there were some kind of transitionary issues of many borrowers not realizing that their payments were restarting after maybe 2 or 3 years of having not made payments. There are some ongoing programs as well to help with forgiving or lessening the amount of debt. For example, the Public Service Loan Forgiveness Program. This one offers loan forgiveness for borrowers after they make 120 monthly payments or 10 years worth of payments while they are employed in a government position or in a few select nonprofit organizations. So whether that's working for the federal government or serving in the military or working for a state or local government, those positions would potentially qualify for this program, after which they would have the remainder of their loans potentially forgiven. There's been a lot of conversations this week and in the months of the 2024 presidential campaign about how will the student debt crisis in higher education change under the Trump administration. It's certainly too early to know, given that there haven't been too many concrete policies identified, at least specifically regarding student loans. But given that the Trump campaign had highlighted dissolving the Federal Department of Education as one of its potential goals, there certainly could be some significant changes to how student debt is handled in America. Now we're going to be taking a little bit of a closer look at what specifically the Biden administration has done over the past few years in combating the student loan crisis. Student debt forgiveness was one of the primary selling points on Joe Biden's campaign for the 2020 presidential election. And in August 2022, the White House published its plans on how it plans to go about combating the student loan crisis. One of these was to provide loan forgiveness of $10,000 to students with an annual income of less than $125,000 per year, and an additional $10,000 of forgiveness to students who were also Pell Grant recipients. The Biden administration had highlighted that Pell Grants had not kept up with rising tuition costs, and so this loan forgiveness was intended to sort of offset that. In addition, the administration made promises to make debt more manageable for current and future borrowers by trying to cut down on monthly payments through income-driven repayment plans, and also to increase accountability for schools to ensure that students are getting an educational experience that reflects the amount of tuition that they're paying. Biden also highlighted free community college and that increased Pell Grant funding as additional means to reduce the burden of the increasing cost of college, especially on low and medium income students. Not all of the plans highlighted by the administration have come to fruition, though. In June 2023, the Supreme Court blocked much of Biden's plan to forgive up to $430 billion of student loan principal across 40 million borrowers, eliminating that plan of forgiving up to $10,000 to $20,000 per student. However, as of July 2024, over $168 billion has been forgiven by the administration across 5 million borrowers.
Looking at current trends and issues, we can see on this graph that student loan debt continues to increase relative to student borrowers. So the number of student borrowers hasn't increased very much, whereas student loan debt has significantly increased. And borrowers are in crisis due in part to rising average debt and a decline in average wage values. So what this means is that, students who borrowed loans from the government, whether they graduate or not, they do not have sufficient incomes to pay their debts when those debts are due. And as unpaid debts continue to accrue interest, repayment becomes less and less likely. Should a borrower fall behind on payments, the resulting impact on their credit score puts other forms of debt relief, such as refinancing or other forms beyond reach. So this can cause an impact on their credit score and subsequently can cause the borrower to lose access to additional lines of credit, such as auto loans, mortgages, or other loans to pursue higher degrees. This typically causes the borrower to fall deeper and deeper into debt. So we can see that this is a continuing issue that seems to only get worse over time. And one interesting statistic was that 20 years after entering school, half of student borrowers still owe about $20,000 each on outstanding loan balances. So this is really a long-term issue that we need to address. Another current trend and issue is that rising tuition costs and decreased state aid has caused students to rely more on student loans to pay for educational expenses. And we can see by the two graphs here that even inflation-adjusted average college tuition has significantly increased over the past years, and appropriation of taxes for higher ed has significantly decreased. Specifically, in the 21st century, the cost of college attendance has increased at an annual rate of 6.8%. And that is a growth rate that is over 196% faster than currency inflation and over 89% faster than wage inflation. So the cost of college attendance has increased at a rate significantly faster than our currency or wages have increased. And this, coupled with the fact that state tax appropriations have declined by over 28% since 2001, places a really heavy burden on student loans to fund that educational expense. As we've all heard with the FAFSA, this past academic year, there has been some issues with the new simplified free application for federal student aid, or FAFSA, has actually caused more issues than it relieved in some ways. So we've all heard about it, and looking at the data from how that rollout impacted students, the delay for the October launch of that actually contributed to 9% fewer high school seniors and other first-time applicants submitting a FAFSA. And of course, this impacts the amount of aid they'll get. I actually remember from when I was a high school senior, I submitted a FAFSA, but I didn't put the college I actually ended up going to on there until about March, and that was after the October launch. And that actually impacted the amount of aid I got for that first year. And every subsequent year, I always filled it out on October 1st to try to maximize the amount of aid that I would receive. So this delay and barriers to actually submitting the application caused a significant decrease in students even applying for federal aid through that form. There are also additional barriers with verifying identities for parents or spouses who don't have a social security number, and this prevented some families from even accessing the application. Unfortunately, rather than simplifying access to student financial aid, this new update actually created more barriers and roadblocks to students, which ultimately impacted the aid they received.
There are many reasons the student loan crisis needs to be addressed, aside from its overall impact on the economy and overall impressions of higher education. First, institutions of higher education are falling short on preparing students for the professions with a bachelor's alone. Halebe and colleagues identified 12 areas where higher education is not keeping up with the demands of the job market, including technological advancement and adaptability in complex and changing environments. Given that the needs of the job market have expanded at a faster rate than higher education can keep up with, it's left both students who are unable to obtain jobs with their bachelor's degrees and employers who need a uniquely talented workforce disappointed. At the same time, the price of higher education is increasing at an unprecedented rate. This combination has made bachelor's degrees less practically valuable while making it literally more expensive. Furthermore, student loan debt is negatively associated with mental health, meaning those that accumulate debt regardless of achieving their degree are unhappier in general. Lastly, student loan debt disproportionately affects students of color, particularly Black students, compared to their white counterparts. This racial injustice adds an additional layer to the importance of addressing student loan debt. So, how do we approach the student loan crisis? First, many scholars advocate for adopting an economic justice perspective. Focusing efforts to reduce overall debt on those who are most economically disadvantaged and enjoy the least benefits from their education should be put at the forefront of any conversation discussing student loan debt. So, what approaches are available to us? As Ben mentioned earlier, student loan forgiveness is one of the most popular possibilities for a solution. Some argue that reducing the overall debt, especially for those who are most economically disadvantaged, would allow borrowers to pay on a small remainder of their loans instead of defaulting on loans they will not have the capability to repay in this economy. Others argue that student loan forgiveness will lead to further economic disparities and decrease the overall value of higher education. As Ben mentioned earlier, the original plans put in place for student loan forgiveness may change drastically or disappear entirely given the shift in leadership. Another possible solution is the FAFSA Simplification Act and borrower transparency. The idea behind this method is to more thoroughly explain how financial aid works and how this can impact you financially. This may discourage borrowers who may not have the capacity to pay back their loans from taking larger sums of money. However, this does little to address how low-income students would access higher education if their only option is to borrow. Lastly, we could improve the overall quality of higher education to better prepare students for the workforce. If higher education not only worked to better prepare students for the job market, but also worked to place them in jobs that offered competitive salaries, students would have a higher capability of paying back their loans. This would also negate some of the distress students are associating with the value of higher education.